Welcome to Wealthy Behavior, talking money and wealth with Heritage Financial, the podcast that digs into the topics, strategies, and behaviors that help busy and successful people build and protect their personal wealth. I'm your host, Sammy Azzouz, the President and CEO of Heritage Financial, a Boston-based wealth management firm working with high net worth families across the country for longer than 25 years. Now let's talk about the wealthy behaviors that are key to a rich life. Welcome to the December investment edition of the Wealthy Behavior Podcast, where I talk to our Chief Investment Officer, Bob Weisse, about what's going on in the investment universe that you need to know right now. Regular listeners will know that Bob and I usually chat at the beginning of the month, but we pushed it later into December because we wanted to provide a little bit of a recap of 2025, maybe get into how our outlook played out and some of the things that we learned from an investment standpoint this year, which we will get into next. But first, Bob, we did make some moves in our portfolio around private credit that I thought were timely and interesting to get into on the podcast today. So with that very long introduction, thanks for joining, and how you doing?
Doing well.
This is an asset class that we have owned since the beginning, right? Since 2009 or 10?
Yeah, we started investing in private credit for clients, I believe, in 2009 through limited partnership vehicles. So that was limited to qualified purchaser clients. It wasn't widely owned across our client base because of the vehicles. Maybe just rewinding a little bit. So if you go back pre-financial crisis, loans to businesses were typically done through the banking system. And then we had the global financial crisis where we found out that some of these banks were levered something like 30 to 40 to 1, where they would have $30 to $40 in loans outstanding for every dollar in deposits. And with that level of leverage, you're really putting the depositors at risk. And we almost had a run on the bank type this scenario back in the global financial crisis. So what happened? The government made regulations limiting lending from banks that take deposits. And the private credit industry was born, so to speak, coming out of the global financial crisis. So rather than companies going to the banks for loans, if you're a private business and you need a loan, they went to basically investment managers. So managers who would raise capital from people like us and make loans to the business at attractive rates higher than you'd get in a corporate bond. And that's kind of the birth of the private credit markets. And it's grown substantially over the last 16 years as there's been investor appetite in that market, and as the baton has been handed off from the banks to the private sector for making these loans. So that's the backstory. In 2019, we started investing in an interval fund, the Cliffwater Corporate Lending Fund, and an interval fund has quarterly liquidity. There were no accreditation qualified purchaser restrictions, so we were able to implement that for our clients where appropriate. So our most conservative clients didn't get it. Our clients who wanted full daily liquidity or no alternatives didn't get it. But for the most part, our clients owned it where appropriate. And our clients did very well in it. So the yields has ranged over time, upper single digits to even low double digits at times. And it's been a very steady performer. And what's happened is investors have taken note of the good returns in private credit, and the inflows have really picked up. So you have a lot of money going into the asset class, and the managers need to deploy the capital as it comes in. And as you have a supply-demand imbalance, in our opinion, where you have more money coming in than good avenues for them to put it to work. So we're concerned that the quality of the deals they're doing will be degrading. A way to think of it, if a manager has a small amount of inflows, they can pick 1 out of 10 deals they see. Pass, do the deal. If they have a large amount of inflows, they might need to do 9 out of 10 deals they see. And as they have to be less selective, we think credit risk ticks up, and expected return goes down. And a way to measure the expected return is the spread you get above the risk-free rate. It used to be around 6%. Now it's down to 4.25%. So that's measurable. We're seeing lower yields. And then in addition, the yield on these private loans is typically floating rate. So it's called the Fed funds rate plus a spread. As the Fed has been cutting rates, the base rate's been declining. So that's no fault of private credit. It's just that's the market environment. So yields are shrinking on the base rate from the Fed cutting rates. Spreads are tightening from the heavy inflows. And we fear that that risk is going up through less stringent underwriting as a result of the heavy inflows. So we exited both funds. One was earlier this week and one was last week.
So I wanted to get into the risk a bit because I know that you and your team have been looking at it, and also just in my travels down, reading and learning things for our clients and for my own benefit, I've seen people be really negative about private credit in the last few months, I would say. I mean, Jeff Gundlach from Double Line was on a podcast where he was really, drawing, 2008 parallels. Somebody who I respect, Howard Marks, who we read his memos, was much less negative on it, and I think more balanced. But there were concerns. I think Jamie Dimon said some things. So talk about the actual risk versus what I heard you say mostly is the return expectation is diminishing with private credit more than we're really worried about the risk.
Yeah, I'd say what I previously said there is more call it the base case. If you want to go to call it tail risk concerns, let's really stress test this and how bad can it get, which you do with stocks. Like it is appropriate with stocks. You can see -20, -30, -40, that's in the cards, and you should be aware of it when you invest. So what's called the tail risk with private credit. So I say that is it's not what we're expecting, but it is out there. Most private credit loans are originated through private equity acquisitions. So a private equity firm will buy a company for call it $1 billion, and they might write a $300 million equity check and then finance the deal with $700 million in loans. That's private credit. And the term of the loan is typically 5 years. And the idea is they buy this $1 billion company, have debt on it for 5 years. There's no way that the cash flow from the business can pay down that debt. But the expectation is they grow the business and it goes from being worth $1 billion to worth $2 billion, something like that. And they sell it in 3 to 5 years. And when they sell it, they pay off the loan. So it's leverage, short-term leverage. The risk is that there's inflows. So this money is easy to get. They're getting out low rates. You've seen deals and a lot of these levered deals. And if the private markets slow down, and with that, there's an outflow in private credit. So think of the flow spigot from coming in starts coming out. Investors start, getting a little spooked. Maybe there's some defaults in the news, and people start asking for money. If that company I just gave the example of the $1 billion company, 5 years from now, that it comes and the PE firm didn't sell the company. Markets are cool, that the price isn't right. And PE does that all the time. They want to get a good exit. If they're not going to get the double, they might hold it, but they need to refinance the debt. In today's market, not a problem. There's plenty of capital to refinance the debt. But if the market cools, it could be difficult. Where then they go and they say, hey, banks, private credit lenders, we need $700 million to refinance this. If there's outflows, finding that capital could get tough. And then you'd see rates drive up. And you could have a systemic issue where all these private companies have a lot of debt on them and it's relatively short term. And if the market isn't as flooded with cash as it is today, you could see a bigger issue. So that's not a base case, but there is a potential storm in private markets that you can see how it could play out. And it's definitely a risk that I think anyone who's involved there needs to be aware of. And I think you need to be compensated for that risk. So it also gets back to where we started with the returns been coming down. The tail risk is kind of ugly. So you definitely want a nice yield for that. And more the base case risk, just I think underwriting standards naturally should be deteriorating as the inflows are so heavy that the managers can't be selective. So on both fronts, I'd say risk is up and then the return is down. And the one other thing I'd add to kind of make that tail risk concern a little more likely is the inflows have been so high that it does look like hot money to me. And that's not a technical term, but
Mhm.
just being in this business for 20 plus years, what you tend to see is fund flows come in and it's steady, and then something does really well, and then just like everyone's piling in. And that hot money comes in late, it comes in quick at the end, and it turns on a dime. So once you start seeing a few bad headlines, it gets spooked and it goes out as quickly as it came in. And that's how you could start to see outflows in private credit. And that's where you could get a domino effect.
But these are illiquid strategies or illiquid vehicles, illiquid funds. Can the hot money flow out as quickly as it could in other areas?
No, it can't, but that's exactly the issue.
Okay.
That like some of these funds you can buy any day of the week, but you can only sell once a quarter, and there's only a limited amount of capacity that you can sell. So the hot money comes in, no problem. Then they get spooked, and they try and get out, and then they get gated, and then all investors know that there's a gate up, and then you get more investors saying, "Oh, I didn't know this thing was gating," and that's the domino effect that I could see coming.
So you get ahead of it as a concern. I know that our investment approach relies on capital market assumptions, long-term return expectations. Do you have a sense of how much lower private credit return expectations are for your team compared to, when we were more excited about the asset class?
So it's a complicated question. The part I left out is you have the base rates going down, you have spreads going down. So if you leave it alone, you're looking at roughly maybe a 2% decline. But then what we're seeing is managers dial up leverage. So these funds can use leverage. So they're borrowing money to make loans, and they're doing that to reduce the yield decline, which when we look at it, that's just another way that risk is going up. So say the unlevered yield is 10, and then the unlevered yield goes from 10 to 8, very simple 2% decline. But then they apply a 1.25 or 1.5x leverage on the yield, gets you up. There's cost for the leverage, so it gets it back to closer to 10. But it's not the same 10. It's a riskier 10. So
They're,
that's one other thing that we're seeing.
they're dialing up leverage while all the hot money's coming in. Doesn't that just make the putting all that capital to work problem bigger?
Yes.
Yeah. Okay. I just wanted to make sure I wasn't missing
So
something there.
exactly, as you see selectivity for deals going down, yields going down, leverage going up, it just adds up to it's nothing against the manager, but it's more just an asset class that we've done well in. Let's call it a win and move on.
And I'm glad you said that because this is kind of an unfair, goodbye to private credit for us for now because it's been an asset class that has served our clients well. Can you just walk through kind of, I know we had different strategies, different vehicles, but what did this provide to our portfolios over the time that we were in it?
Yeah, it's been mid single digits, upper single digits, even teens at times, or at least double digit returns, pretty steady. So since '09, it's a lending strategy that's had very little defaults. You can argue many people criticize them for a lack of marking to market the assets. There's probably some fairness to that, but what it's resulted in is, on paper, at least a very smooth experience for end investors, where you're getting the yield, and the yield is a healthy spread above the risk-free rate, and you're seeing very little volatility. So it's been a smooth ride to get good returns for clients.
And a lot of that was during a time period where yields were very low, right? And it was
Yes.
tough to get good returns in traditional fixed income. So one last thing on this before we move on, you mentioned, a lot of hot money coming in and, you put that to work and, you're not as excited about how, you're allocating it and the deals and the quality. Why isn't that an issue with private equity, which has also seen a ton of money flood into it over the last, I would say, I guess the same time period, but probably longer than private credit?
Did I say it wasn't an issue?
You
Um,
didn't say it was an issue, but we do allocate to private equity, not as broadly, because we are only doing it for a limited client base. And private credit, with the interval funds, more clients can get into it. But
yeah.
it, what are your thoughts on, how come money coming into private equity hasn't, completely pulled the plug on it for us?
No, you can tell I have an 11-year-old daughter at home from the sass in that response. Sorry about that. But no, it's fair. And we are concerned about private equity as well, because if in that scenario where I played out, private credit having outflows, it being tough to refinance deals, private equity is not the place you want to be either. So there's risk on that. And then the probably the bigger concern with private equity is valuations. It used to be what you would call an illiquidity premium. So if the public markets trade at 20x, private equities buying companies at 15x or so, 10x, all else equal, and that seems to be going away. Even cases where private equity is paying more than public markets are trading at. So there's been a shift where private equity used to be a sliver of companies. If you were to look at companies, call it, revenue greater than 100 million, private equity would be low single digits percentage. Now, if you slice the US market, say companies with an enterprise value below 2 billion, it's roughly half of them are public, half of them are private. So private equity has really grown, and as a result, valuations have gone up. So with that, I'd similarly say risk has gone up. We do have some concerns there. We're definitely being selective with what we're doing in private equity. The main thing we like to see in private equity, and we're really going to look for, say, when we underwrite our next opportunity, is a manager who is active and drives value through controlling ownership. So a good PE manager who goes in and makes organizational changes. A typical one might be like, building out sales and marketing. You have a great product or service, but your website stinks and you don't have much of a sales force. So that's an easy one. Operational improvements, maybe leveraging AI, maybe getting better systems in place, and strategic improvements like entering new markets. So I do think that blueprint is sound and always will be, where you find a business that's just not well run. But the problem is, as private equity's grown, there's very few of these, call it billion-dollar companies, that are just mismanaged and ripe for PE to buy. 10, 20 years ago, I think there were plenty of them, and PE could be very selective and cherry pick. But now that there's so much money in the PE marketplace, you're seeing more deals where PE is buying a PE-backed business, and call it the juice has already been squeezed out of the orange, so to speak. So we are, in general, more skeptical of private markets.
Okay, well, that's good. I appreciate that. I didn't think you were sassy at all, actually. I thought it was a funny answer. But let's pivot to recapping 2025. I reread our market outlook at the beginning of the year, which we shared, and I'd like your thoughts on it. But it's an interesting exercise because it's more of a 10-year market outlook, right? It's not a, hey, here's what's going to happen in 2025 crystal ball outlook. And as I read it, my takeaways were, a little bit of a concern with valuations in the U.S., particularly with a certain segment of the market. The stocks we talk about a lot, the large tech. Talking a little bit more about international diversification, a little bit more optimistic about fixed income because yields were higher in quality spaces, and not, saying we're on the cusp of some really bad stock market returns, but maybe dial down your expectations over the long run, just given the run that we've had. And then we get into this year, and we had a lot of stuff that we've talked about during the year, tariffs being, a big one, inflation, the Fed, and we've had another really strong year in the markets. So, how do you feel about how our outlook played out so far, 1/10 of the way in? And given that we've had another good year, the valuation concerns, some of the themes that we talked about at the beginning of 2025, I would imagine those are still issues rolling forward, right?
Yeah, so you're referencing our long-term capital market assumptions. Those are designed for 10 years. And it's tricky because when you look at valuations over 10 years, they are meaningful, like that they're pretty indicative of what the future holds. Over 1 year, they're pretty much meaningless. So to use capital market assumptions and then a year later say were we right or wrong, it's there's so much randomness in it. Multiple expansion can happen, so it's tough to really assess capital market assumptions. But on the face of it, we were saying valuations are high, and returns 12 months later were quite strong. So, I mean that's a fact. But our valuation's still higher, even higher now. Yes, they're higher now. So I don't expect our tune to change that much. I do think when we present the data, we typically do hedge it that way, that this is a 10-year assumption. Over 1 year, 2 year, 3 year, anything can happen, and it's not meant to be meaningful. I pulled up our slides from the Heritage 2025 market outlook that we did in January. And the first real intro page said, New administration alchemy executive order, tariffs and inflation. Questions remain if Trump can use executive action to enact tariffs. And I'd say that kind of played out and is still playing out. And then the second one was politicized Fed, unknown, unlikely to attempt to remove Chairman Powell. His term's up in May 2026. And I'd say a politicized Fed has definitely been a topic this year. And then as you go through the deck, we ended with showing the valuations of foreign equities relative to US being the most attractive they've been on the chart. And foreign equities have had a great year this year. So, call it a win on some of those fronts, but the overall tone of, hey, expect less from returns, I mean, that was wrong as measured by 2025. It's been a good year for investors across all asset classes.
Yeah, and I wouldn't say it was wrong. It was just, hasn't played out yet necessarily. And I think if you're going to be wrong, that's the direction clients would want you to be for sure. So, just to unpack a couple of those things as we look forward, I've seen data that typically shows when international markets start to outperform, it continues for a while. Are you a believer in that this could be a more persistent theme going forward or not?
The data definitely supports that. And if you look back like in the 80s, it was a great decade for international. Japan did really well. 90s US, 2000s international. Since 2010 plus, it's been US. So the data shows the baton going back and forth roughly in decade stretches. So and then besides just looking at the data, is it sensible that you have these cycles where certain things are in favor, there's certain patterns, and it does add up. And if you look at where the dollar is from a valuation standpoint and compared to history, it is still, call it on the fair to expensive range historically. So there's definitely room there. So and then valuations of equities are pretty attractive overseas still. It's moved in a little bit, but not too much. So I definitely think that there's more room to run for foreign equities versus US.
And in hindsight, do you think that tariff and Fed politicization, I don't know if I said that correctly, fears were overblown?
Tariffs, no, because when that Liberation Day, when Trump came out with those tombstones and those initial numbers, if they actually followed through with that, I don't think that could have been overblown. Now you could say, should investors have been smart enough to say this isn't going to happen? But I can't fault investors for taking the president at his word.
I guess
So
maybe a more constructive way of asking that question, Bob, is do you think some of the weakness we're seeing in the labor market now relates to the increase in tariffs from the spring and summer?
no.
Okay.
I have a different view on that. It's a different topic, but I think it might be from AI, honestly,
Okay.
increased productivity that we're seeing trickle through because we're seeing strong corporate earnings, strong GDP growth, which typically doesn't add up with increasing unemployment. So how are companies making more money? How's the economy growing at a nice clip while unemployment's ticking up? Normally you see a corporate slowdown, an economic slowdown with a slowing labor market. So that to me points to higher productivity, which just with how, I mean, maybe it's just because I see AI in the news every day, but I suspect that companies are leveraging technology more and more and becoming more efficient, which is why you're seeing strong earnings and they're needing less bodies to make profits.
All right. And I don't want to have to say this word again, but Fed politicization fears overblown or not in 2025?
I think that's real. I don't think the Fed did anything in 25 as a result of politicization. Make me say the word. I think Powell's got a strong backbone and he did what he thought was best. But in 2026, when they name a new Fed chairman, there will be political influences behind that. Just that's how the system works. And maybe there's some market awareness of that. So I guess you actually could back into maybe Powell did some actions, because if the market is expecting, call it a more dovish chairman in 2026, who will have an inclination to push rates lower, then the market starts expecting that, and the market starts pricing in lower rates. And then if Powell isn't cutting rates to kind of get in that direction, it could be a surprise. So it's a bit of a stretch, but it's more the 2026 expectations than saying that Powell was pushed by Trump. I don't think that's the case.
All right. And you started talking about AI sitting with you in a few client meetings in the last few weeks. You're getting the question more. Are we in a bubble? Are these names something to worry about? I've seen you answer it consistently, one-on-one a few times. How would you answer that for our listeners?
Yeah, it's been coming in a lot. People, I guess it's in the news, and we're getting these questions, are we in an AI bubble? And there's two ways to look at it. I mean, the short is we don't know, but there's on one hand, there is a lot of positive things going on that support investing in equities. So I mentioned you have increased productivity, increased strong earnings, strong GDP growth. And while the labor market, with unemployment ticking up, that is leading to a dovish Fed. So you have a Fed cutting rates. So a stimulative Fed with a backdrop of a strong economy and strong corporate earnings, that's a great environment to be investing. And when you look at inflation, I believe it's around 2.8, but at the last press conference, Powell said about 0.6 of that is from tariffs, and that's a one-time effect. So he believes that more the real inflation rate's around 2.2, which is great. So if you have stable and kind of on target inflation paired with a slightly weak job market, so you have an accommodative Fed with a backdrop of a good economy and good corporate profits, it's a nice time to be investing. And then you're dealing with transformational technological change that is good, but if you get into how you value a stock, just to think about it a little bit, technically it should be like a discounted cash flow methodology where you're basically trying to estimate all cash flows a company ever makes. It's a very non-precise or difficult exercise to do. If I were to say, tell me what the present value of every distribution to shareholders from Apple stock is. It's a wild guess, basically. I mean, you could build models, but it's difficult. And the point is, as you adjust for inputs like, okay, now throw AI into the mix, how does that change your model? It can change it a lot. And historically, when you have big technological change, like the tech bubble in the 90s, even going back to railroads and electricity, the market does tend to overshoot. And it's just people try and price it all in, and it's tough to price it all in. Inevitably, they price too much in, and stocks get too high, and the air has to come out of the balloon. But we don't know where we are in that cycle. So there's, I think, a fair chance that this time around will be similar to the 90s. It's just, is it 1996 right now or 1999? And I think a fun fact I shared with you the other day that you knew, but Alan Greenspan, former Fed chair, used the term irrational exuberance to describe the stock market environment. And he first used that in December of 1996. So if you said, oh, gee, the Fed chairman's saying that we're being irrational buying stocks at these levels, if you got out of the stock market in December of 1996, what you probably would have done would be sit on cash for a year or two if you could have, missed out on a lot of gains, and then got in 1999 just in time to lose your shirt. So these things can carry on for a while, is the point.
Is it the main difference between now and then is that these companies now are making money? They're making gobs of money, and the internet companies back then, a lot of them were not. Or is that an oversimplification? I mean, are there AI names that are just going through the roof that, are not registering on because they're not in the Mag 7 that are just hype and not making money?
No, that's directionally fair. That
Okay.
the companies are more profitable today. The big names are definitely more established businesses. What I would flag more of my concern is that with change like this, there, as you'd expect, are winners and losers, and the market and participants are acting like everyone's going to be a winner. If you take AI models, for example, and you put Gemini versus ChatGPT, probably the two that are in the lead. who knows 5, 10 years from now, which one of them will be the winner. And there's obviously other models as well. So if you go back to the 90s and think about search was big, and web crawler, Lycos, there were so many of them. Think about browsers. You think about all the technology, even social media, MySpace. Markets have to work it out before you find an eventual winner. And I'd expect, just like every time we've had big change, there to be winners and losers. So all of this boils down to diversify. If you've got big concentration in one or two of these big tech names, that might be something to work on, and invest beyond just big tech in the US.
I think it doesn't get said enough, but if you are concerned about valuations and you have these questions and you're coming in and you're talking about them, great. It is something to add to the list of concerns in the investment universe right now. Fine, there's always, things to be worried about, but it doesn't mean what you may think it means, in that, well, now I got to make a whole bunch of changes to potentially address those concerns, because that's where you get into trouble.
A way to think about it is, if you were to say, okay, no, it is an AI bubble. It's going to look like a capital A, right? Shoots up, crashes down. What do? Well, ideally, you get to the peak and then you go to cash. That would be nice if someone could tell us when we're at the top. But more realistically, as you're climbing up the A and the ascend, you're taking profits. So, and maybe you start the ascend at 65% equities, and those equities are going up, and you dial down your target from 65 gradually to 60 or 58. So you're not just taking profits, but you're reducing the target as you go up, so that when the downturn comes, you can dial the target back up. And that's basically what we're doing. We have moved a little bit of our money from equities to bonds as far as our targets. So we have been reducing the target in equities, but you don't want to be binary with investing really ever, where you're either all in or all out. You want to participate in the ascend because it can keep going for a long time. But we have been slowly, gradually increasing the defensive positions in our portfolios like treasuries.
Great. Well, with that, Bob, I will say goodbye to you till next year, officially on the podcast, although I'm sure I'll see you in a few minutes down the hall. Thank you for everything you've done this year on Wealthy Behavior. I know our audience and listeners love hearing your insights as you manage a large investment portfolio.
Thanks, Sammy. See you next year.
All right, bud. Thank you for listening to Wealthy Behavior. If you found the conversation useful, please leave a review wherever you listen to your podcasts, and share this episode so those around you can live a rich life too. We appreciate your feedback and questions. Please email us at wealthybehavior@heritagefinancial.net. For more insights, subscribe to our weekly blog at heritagefinancial.net and follow us on Facebook, Twitter, and LinkedIn. Check out my personal finance blog at thebostonadvisor.com. Wealthy Behavior is produced by Kushal Kakamis.
This educational podcast is brought to you by Heritage Financial Services, LLC, located in the greater Boston area. The views and opinions expressed in this podcast are that of the speaker, are subject to change, and do not constitute investment advice or a recommendation regarding any specific product or security. There is no guarantee that any investment or strategy discussed will be successful or will achieve any particular level of results. Investing involves risks, including the potential loss of principal. There has not been and will not be any compensation exchanged between Heritage Financial Services and podcast guests or recommended resources.